Almost immediately after completing my last video, the 2019 crypto bull case, I realized I missed a few things, so I wanted to circle back and add a supplement. If you want the full bull case, please watch that video as well. The first thing I missed was the halving. As most know, new Bitcoin are issued via a system of mining, whereby computers solve math problems and secure the network, and for this, they are rewarded newly issued Bitcoin. Built into the Bitcoin protocol is a disinflationary monetary system, meaning the rate of inflation for Bitcoin decreases over time, eventually reaching zero. It does this through a series of halving events. These events mark the reduction in Bitcoin mining rewards and should occur about every 4 years. When Bitcoin first launched in 2009, the mining rewards stood at 50 Bitcoin per block, which were issued out about every 10 minutes. The first halving occurred November 28, 2012, and resulted in the rewards being reduced to 25 Bitcoin per block, thus the name halving. The second halving happened on July 9, 2016, again reducing the rewards by half to 12.5 Bitcoin. The next halving should occur in the spring of 2020, just about 1 year from now. Each of these events occurred about 1 year after the bottom of the Bitcoin price cycle, and the crypto bull market continued for about 1 year after the first event and about 18 months after the second. Observing these trends, it's understandable why market participants believe this is a bullish event. From a fundamental standpoint, the effects of the halving should have a reduced effect for each event since the mining rewards become smaller compared to the circulating supply, but there are other factors to be considered. For example, bullish sentiment around the halving becoming self-fulfilling. As market participants anticipate rising prices around the halving, they are less willing to sell, reducing the supply further, forcing up prices. This includes Bitcoin miners, who attempt to hoard their rewards leading up to the halving to sell them at higher prices later on. I think Anthony Pompliano also made a great point on CNBC.
We're about a year out from the halvening, so it's going to get about half as scarce in the monetary schedule.
That sounds really exciting.
Historically, that's been a big moment in terms of it really is a price driver because it reminds people that there's only 21 million of these.
With much of the current supply already lost due to a multitude of issues, and nearly 40 million millionaires in the world, not only is it impossible for every millionaire to own a whole Bitcoin, it's impossible for each one to own a half a Bitcoin. For every Bitcoin you or I own, that's another millionaire that's out of luck. The next halving is set to occur in late spring of next year. Now, of course, the halving is a Bitcoin-centric event, but as goes Bitcoin, so goes the altcoins as well. As the saying goes, a rising tide lifts all boats. No matter how much you hear from the Bitcoin maximalists that Bitcoin is decoupling and going to take over because it rises faster than altcoins at the beginning of a bull market, don't believe it. I was hearing Bitcoin maximalists taking a victory lap when Bitcoin broke out and initially alts didn't follow. I was planning on doing a standalone video to assure those holding altcoins that they would eventually catch up to Bitcoin's gains and likely outperform. But that began to occur before I even had the chance to start. Bitcoin regularly inhales from new investors and then exhales that capital into the altcoins in the so-called alt season. This has happened repeatedly in the past, on various scales, and will occur in the future. It is foolish to believe that Bitcoin will be the sole platform to succeed. Some of you might know my favorite to challenge the king at some point. This is all to say that any Bitcoin halving effect will also drive a bull market in the rest of the cryptocurrency space. Next, I'd like to expand on a topic from my last video, the idea of cryptocurrency as a financial crisis hedge or safe haven. A friend of mine had watched my last video, and being new to learning about crypto, was understandably skeptical. He too was concerned about the potential of a debt crisis, but wasn't sure why crypto would be a safe haven. The first reason I gave him was in a debt crisis or credit event, you don't want assets that are tied to or dependent on debt. All kinds of bonds are debt instruments, so are obviously out. As outlined by Ray Dalio, debt crisis often results in the devaluation of currency, so fiat is out. Real estate is almost exclusively purchased with debt, and if credit tightens as much as is possible in a debt crisis, real estate prices would likely crater. Though there is margin debt, most investors don't buy equities with debt, But there is another major debt-related issue when it comes to stocks. They have inherent leverage. American corporations have gorged on debt since the financial crisis, and investors may be unaware, but there's $9 trillion of corporate debt built into American stocks alone. Many believe corporate debt could be at the epicenter of the possible upcoming debt crisis. As with stocks, there is some margin borrowing for crypto trading, but the vast majority of cryptocurrency is not bought with leverage. Though there are some shocking stories of people taking out second mortgages on their houses to buy crypto, this is rare. The stories are so shocking because most understand that investing in cryptocurrency is risky, and taking on a second mortgage or maxing out credit cards to buy is not prudent. In addition, most crypto platforms do not allow purchases with credit cards. This is all to say that a credit crisis would not hit the crypto market like it would the above-mentioned asset classes. There is only one other asset class I can think of that's less tied to debt, and that's precious metals. While precious metals could also enjoy a bump if the colossal debt load comes crashing down, crypto has one large advantage over the shiny stuff: transportability. If a credit event occurs, trying to board a plane or go through a port with gold and silver could be hard in places like the US or Europe, and impossible in places like China as additional capital controls are put in place. There are also risks and costs associated with storing precious metals abroad. Cryptocurrency is infinitely easier to move. Private keys can be stored in a manner that would be impossible to find by customs or border authorities, particularly compared to gold and silver that could be easily detected by a metal detector. My final point is around a series of stories put out by a few sources that an over-the-counter trade facilitator had a request from a client to buy 25% of the circulating supply of Bitcoin. This seems like an outlandish claim, but there are countless entities that could put out the estimated $35 billion to buy a quarter of the Bitcoin supply at current prices quite easily. This could certainly push up the price, but that could be the exact effect we're seeing in the crypto market this spring. Information like this is exactly what could cause the institutional fear of missing out touted by Mike Novogratz and Tom Lee. And it may not just be financial institutions that could start to get the FOMO bug. Sovereigns could start to watch Bitcoin keenly as a possible strategic asset and buy it for national security or monetary stability reasons. So between the H-bar bull case video, the opportunity of crypto returns and proof of stake in the upcoming bull run, the 2019 crypto bull case, and this supplement to the bull case, I have put together well over an hour of reasons to get involved with cryptocurrency. My site and channel started with monetary history and macroeconomics. You may wonder why I've devoted so much time to focus on cryptocurrency. The answer is simple. I truly believe crypto is not only a once-in-a-generational opportunity, but a once-in-a-multi-generational opportunity. The return on investment for some has been unprecedented throughout history, and crypto may have been invented just in time to protect investors during a very tumultuous time, but also allow them to prosper. The goal of my videos is to be helpful, informative, and entertaining. And currently there is no other subject that does this as effectively as DLT platforms. That said, I'm the first to admit that I could be wrong. Older investors should invest no more than 1 to 3% of a portfolio into cryptocurrency. It would be imprudent for even more risk-tolerant young investors to invest more than 3 to 8%. Finally, a small update to the progress of my favorite cryptocurrency platform, Hedera Hashgraph. As mentioned in my last video, micropayment testing Phase 1 was completed a few months ago, and Phase 2 is ongoing where you can earn 250 H-bar, the platform's cryptocurrency. Continued testing will continue for Hedera's file storage and smart contracts, where testers will be able to earn even more H-bar. Even more exciting, we can expect more council members to be announced in the weeks to come. And open access and trading on exchanges is expected before the end of the summer. For a full rundown of Hedera, watch my Hedera bull case video, visit hbarprice.com, #hash.info, or check out the many resources put out by the team. If you're interested in Hedera, I've learned the next webinar by the inventor of Hashgraph, Lehman Baird, on June 20th will not be one to miss. Click on the link below to register. Thanks for watching, and good luck.